infra and Capex space right now. We have Vinayak Chatterjee, founder and managing trustee at the Infra Vision Foundation, who's joining us on the show today. And Vinayak, hi, thanks so much for joining us and wishing you a very good morning. Give us a sense of the budget estimate that we've seen for Capex for 2025-26. That's pegged at 11.2 lakh crore rupees. What are the key factors that could impact or influence the actual realization of the target?
So let me step back a little and give you first the macro picture before doing a little deeper dive on infra specifically and some of the other micros related to Capex. Now, as mentioned in the last economic survey, the key macroeconomic indicator of capital formation in the economy is gross capital formation as a percentage of nominal GDP. Now, if you recall, during COVID and after COVID, it had fallen to the late 20s, 28, 29%. FY22 was 29.6% was the gross capital formation as a percentage of nominal GDP. Then it climbed to 30.7, and in FY24 it was 30.8, and we are expecting it to be now hopefully touching about 31 or 32, which was around the very good peak levels seen in yesteryears. So at a macro level, gross capital formation, or Capex as we abbreviate it, does not seem to be a fairly serious macroeconomic issue. I think we are doing pretty well there in terms of the macroeconomy. If I were to dissect and go back to your question, there are basically 4 levels of Capex happening in the economy. And I'm going to talk about the basement, level 1, level 2, level 3. The basement is really public expenditure on infrastructure and allied matters. That was your question, right? We will talk about that. On top of that sits social infra. On top of that sits the regular manufacturing type of infra. And finally, on top of that sits some of the very interesting new areas emerging, which are drawing a lot of Capex. So let's go back to the basement. So far as your question is concerned, the 11 lakh crores allocated in this year's budget has a simple thumb rule, which is that over the years we have seen that whatever the center spends in the union budget, a matching amount is spent by the states, private sector, and extra budgetary resources, broadly meaning public sector in general, spends an equal amount. So the 11 lakh crores in the union budget allocated will effectively translate into anywhere between 22 to 24 lakh crores worth of Capex in this fiscal year. And I think that's going quite well from the various micro indicators that we have. And one of the micro indicators is the website of the National Infrastructure Plan, NIP. The NIP data is fairly regularly updated quarter-wise. And the latest figure that I was able to access shows that of the 169 lakh crores of projects that have been identified for implementation in the country, and remember, these are all projects which are 1,000 crores and above, which are listed in the NIP, 82% are still under implementation. So that means 82% of 169 lakh crores is about 138 lakh crores. These are the 138 lakh crores of projects are currently under implementation. Now, assuming with all the problems and bottlenecks that it takes 5 years to complete this pipeline, that gives you a investable potential of around 27 lakh crores per annum, which is not vastly different from what I told you earlier, that the union budget into 2 targets around 24, 25 lakhs. So we are pretty close there. And this is going well. The fact that there is a massive pipeline of investable projects, the usual roads, highways, railways, electricity, power, transmission, all of them add up to a fairly robust pipeline, and there is no shortage of resources. All good projects are today getting funded. So that's my baseline to say that infrastructure is doing well, and all businesses and companies associated with infrastructure construction and allied intermediates like steel, cement, etc. are likely to do well. Now we come to the next level, which I spoke about, which is on the base of core infrastructure or regular infrastructure sits the vast area of social infrastructure, health, education, hospitality, and real estate. Now, as you can see across India's towns and cities, there are hotels are booming, new hospitals are coming, educational institutes are being set up, and there's a lot of talk about privatization of education also, and real estate, is flourishing across practically tier one, tier two, tier three cities across the country. So the social infra piece is giving a fairly strong sense of confidence. Now come to the regular manufacturing. As Punita said earlier on the show, and I was listening to her, there is a certain resurgence of interest in manufacturing that may be coming from sectors like electronic vehicles, electronics, metals, many of these areas where new manufacturing capacities are being pharmaceuticals, which are being set up, irrespective of whatever marginal slowdowns you're seeing in FMCG, in urban consumption and all that. These are areas where fairly large swaths of Capex is coming into manufacturing. Other than, of course, the manufacturing that supports core infra. For example, cement has seen fairly robust growth. Quarter by quarter, it is seeing 7, 8, 9% growth in volume terms. And, companies like Ultratech has seen 17% growth in volumes in the last quarter, and Ambuja and ACC have all seen around 14%. These are the two big cement companies groups. So obviously, with the Capex doing well, you are seeing the fallout in intermediates like cement and fresh capacities coming in steel, as with Sajan Jindal's big new project in West Bengal, etc., etc. So public infra and social infra are doing well. Regular manufacturing capacities are coming up, particularly in newer areas. Whereas the older factories are still waiting, I suppose, many of them for their capacity utilizations to hit 80% before fresh investments are announced. But the newer areas of infra and the infrastructure supporting infra are doing well. Now, which brings me to the last, the last level sitting on top, which I'm very excited about, which is basically the new areas that are getting a lot of attention from Indian corporates. This is first related to renewables, which is pump storage and battery manufacture. Then we come to data centers. Huge interest right now in corporates setting up JVs and facilities in defense. There is already a policy coming out to allow private sector in nuclear, and a lot of corporates have set up backroom offices to exploit that opportunity, smart meters, etc. So what I'm telling you is that other than the traditional factories that we talk of, there is a new burst of products and services of the kind I listed that are seeing a fresh burst of enthusiastic investment. So to cut my long story short, this is what I thought was the broad picture on Capex. But over to you.
Well, certainly, Mr. Chatterjee, thank you so much for such a detailed answer. There was so much that we wanted to ask, but you helped us with almost all. But I just wanted to touch upon the housing Capex, because that is also one of the key themes that the government and the private players have been focusing on. And in FY25, we have seen the housing Capex rising by 5 times on a YY basis. Do you see this as a one-off bounce or a part of a longer structural trend in the real estate cycle? Because whenever we see real estate cycle playing in an economy, it stays for almost a decade. So where are we in that cycle, and how do you see the numbers shaping up?
I would tend to agree with you that we are going to see this as a decadic event for a decade, for a variety of reasons. First, it's a combination of public expenditure as well as private. Please do not underestimate the amount of investments being made in the Pradhan Mantri Awas Yojana. Across the length and breadth of the country, there are housing projects coming up for the economically weaker sections, which is the Pradhan Mantri Awas Yojana. Please also remember that, with projects like Dharavi setting the trend, many large Indian cities are now actively drawing up plans for slum redevelopment, which is going to provide a massive impetus to new real estate development. Over and above this is the availability of housing loans across the board in a much easier manner than was available earlier. So many, and of course, as we know, the country has a housing shortage, and there is always the middle class aspiration for owning a house rather than staying in a rented, and that's playing out. So when you add up all of this, you are seeing what you just mentioned. You are seeing a very good uptick in the housing market, particularly in also the retail and the public works sector, which to my mind is clearly a decadic journey.
You were just highlighting as to how renewables, metals, housing, batteries, they were the key beneficiaries of the FY25 Capex churn. And of course, chemical and electronics somewhat moderated. While you did highlight where you see Capex actually moving, would you still say that we're at the nascent stage and we haven't built the economies of scale perhaps to compete at a global level? Or do you think we're rising up the ranks?
That is a politically loaded question. But anyway, let me answer that. Quite honestly, the whole world is watching because the really large scale up of manufacturing is really only China. And it will be a long time before India can aspire to set up the mega capacities across so many manufacturing products and sectors that China has done over the last 20 years. Having said it, is that something hugely to worry about? Not necessarily. Even with smaller capacities, with a lot of focus on ease of doing business, labor productivity, new technologies, JVs, India can hope to compete. And I would say that we are well poised, even in terms of geopolitics, to a large number of companies that are looking to relocate to India or create fresh bases in India. We are already seeing trends of that. And hopefully, as the tariff structure plays out, I am hopeful that India is actually going to see a cost competitive advantage in the new regime of tariffs, which will allow our manufacturing sector to export far more. Let's hope for that.
And I purely asked because there's so much around the rare earth minerals right now, and suddenly the world is realizing that 90% of the processing till now was in China. And we're waking up to new data points every day on how much the world was dependent on China because of the economies of scale perhaps that they had.
While you rightly pointed out rare earths, if you go sector by sector of most manufacturing sectors, you will find, to increase your concern, the stranglehold that China has across so many products and services, not just rare earths. Rare earths has just come to the surface because it is currently under discussion. But across the board, there are chemicals, there are pharmaceutical molecules and intermediates, there are electronic parts, there is chips, there's solar modules, there are number of industries and products where China has a stranglehold. Now you're seeing how this Chinese company BYD in electric cars, EVs, is overtaken Tesla in terms of volume and sales, even in Europe and many other countries in the US. So the stranglehold is not just on rare earths, but across so many segments that in the months ahead, it will be very, very interesting to see what happens to the world's supply chains in this great war between the nations.
Absolutely. That list really continues, and I only mentioned rare earth because, that's topical right now. But yes, the list really goes on. But Mr. Chatterjee, so good to have you on the show. Thank you so much for your time today.
Thank you. Thank you. It's been a pleasure.
Okay, let me now welcome on board Mr. Kamakodi, the MD